Imagine two families. Same city. Same economy. Same rules. One begins with only wages. The other begins with ownership. 30 years later, their lives look nothing alike. Both work hard. Both pay taxes. Both follow the law. Both believe effort brings reward. But the outcome is radically different. One struggles to stay afloat. The other quietly accumulates power. The difference is not talent. It is not intelligence. It is not morality. It is structure. Invisible. Quiet. Powerful. Since the 1980s, wealth has concentrated upward. The top 1% gained unprecedented share. The middle slowly eroded. Wages moved inches. Assets moved miles. The gap widened year after year. The economy changed. It shifted from labor to ownership. From effort to assets. From salaries to capital gains. The rules evolved quietly. Few noticed the turning point. Think of the economy as monopoly. But not a fair game. One player starts with hotels. The other starts with debt. The banker keeps printing money. And the board slowly tilts. Then came financial crises. Markets trembled. Banks faced collapse. Panic spread globally. Governments stepped in. Money was created instantly. Interest rates fell near zero. Trillions entered the system. The goal was rescue. Prevent collapse at all costs. Markets stabilized. But something else happened. Asset prices surged. Stocks climbed relentlessly. Real estate exploded. Those who owned watched their wealth multiply. Those without ownership watched from the sidelines. The divergence accelerated. This is compounding. Wealth generating more wealth. Dividends buying more shares. Rent funding more property. Growth feeding growth. Like gravity pulling upward. Wages move slowly. Raises are incremental. Inflation eats quietly. Rent rises faster. Groceries cost more each year. Savings struggle to grow. Time feels expensive. Assets move differently. Stocks rebound quickly. Property appreciates silently. Dividends arrive quarterly. Gains compound annually. Ownership moves faster than effort. The tax code reinforces it. Salary is taxed first. Investment gains are taxed later. Sometimes lower. Sometimes deferred. The difference compounds over decades. Then there is leverage. Borrow against assets. Buy more assets. Let appreciation pay the debt. Repeat the cycle. Scale multiplies advantage. Access matters. The wealthy access private deals. Early investments. Insider networks. Exclusive funds. Opportunity arrives sooner. Meanwhile, the middle relies on wages. Limited capital. Limited access. Higher borrowing costs. Slower growth. Narrower margins. Wealth compounds across generations. Assets are inherited. Trusts are structured. Estates are protected. The starting line shifts forward. Advantage becomes permanent. Meanwhile, debt compounds too. Student loans. Credit cards. Mortgages. Interest accumulates silently. The burden grows heavier each year. Crises accelerate the pattern. Asset prices dip briefly. Then rebound stronger. Rescue flows to markets first. Recovery favors ownership. The cycle tightens. The result is divergence. Not sudden. Gradual. Structural. Invisible to some. Obvious to others. A widening economic canyon. Then came 2020. The world paused. Streets emptied. Markets crashed. Fear spread faster than the virus. Uncertainty froze everything. Panic returned to markets. Indices collapsed in days. Wealth evaporated on screens. Investors feared another depression. The system trembled again. Governments responded instantly. Trillions were authorized. Central banks expanded balance sheets. Liquidity flooded markets. Rescue was immediate. Collapse was avoided. But stimulus did not flow evenly. Markets rebounded first. Stocks surged to new highs. Asset prices soared beyond pre-crisis levels. The wealthy recovered quickly. Billionaire net worth climbed rapidly. Tech fortunes doubled. Asset holders expanded their empires. Meanwhile, small businesses shut permanently. The divergence widened again. Housing markets overheated. Prices jumped beyond reach. First-time buyers hesitated. Investors bought aggressively. Ownership concentrated further. Inflation followed. Everyday goods cost more. Wages lagged behind again. Savings lost purchasing power. The middle felt the pressure. Quietly. Markets are not the same as people. Saving Wall Street is not saving Main Street. Asset stability is not wage stability. Yet policy prioritizes financial systems. The pattern repeated. The revelation was undeniable. The system protects ownership first. It stabilizes markets before wages. It rescues capital before labor. It rewards assets structurally, not accidentally. The system is not broken. It is functioning as designed. Ownership compounds. Influence concentrates. Power follows capital. And the cycle continues.